Why struggle through a post-merger integration when you can glide through it? Why deal with the PMI integration challenges when you can overcome them even before they occur? Why move slow when you can move at pace? What are the world's leading PMI experts doing right now to achieve profit-accelerating integrations? This podcast will give you all the answers to these questions and many more. My name is Dudley Peacock and welcome to the 100 Days and Beyond podcast. Good morning, Rupak. How are you?
Good morning, Dudley. How are you?
Yeah, very good. Thanks. Very good. Let me just welcome the audience. Thank you very much, everyone, for joining us today. We've got a fantastic guest. We've decided to spice things up a bit, but 100 Days and Beyond is a podcast that we've dedicated to the M&A world. I would say the post-merger, post-acquisition integration specialists, or even those that take part in it, observe it, have experience in it, or even just have a view on it. We've got multiple people of different backgrounds and experience that have been on the show already, and the show has been absolutely magnificent in terms of the broad scope, the depth, the breadth of knowledge and experience we've had so far. But today we've got somebody different. We've got somebody special, and I think Rupak is going to be a really great addition to our podcast series. And I'm just going to quickly go through some of your key points on your LinkedIn profile, Rupak, before I get into the rest of it. But on your profile, I mean, you talk about building Lego, which we're going to talk about, or LEGO, which we're going to talk about, early warning systems in London. So enterprise software scale-up CEO focused on business development, marketing, and product development. You would have seen a number of M&As. You would have seen a number of things. Thought leader on FinTech. Regularly appeared in leading publications. Won awards for top trading and tech executive. Led industry consortium projects with senior management of banks. I mean, it's quite good. I mean, if you look at them, generating 250% shareholder return.
I'm blushing now, Dudley. Stop.
Unbelievable. I mean, if you just look at this, at this wealth of experience, and I mean, wow. Thank you for joining us today, and tell us, just talk to us a little bit. Give us your journey, give us your world, and sure, where you are right now and what you're doing.
Sure. I think, as you highlighted to your viewers, my background in M&A is slightly different. It's much more from the I would say the cooking the dishes rather than serving them, less so on the integration side, but more on, what makes good M&A, what makes bad M&A, trying to drive M&A from a sort of pre-integration process. So I was an equity research analyst for my sins for 12, 13 years, looked at a lot of M&A from the perspective of shareholder value, seen some good deals and seen some bad deals. And, often at least in the public markets, there's a natural reaction to M&A, but often further down the track, it can be very different. I still remember when BlackRock bought BGI, the big index business from Barclays, and everyone thought it was a bad deal. And it was one of the best deals in financial services history. So, I think M&A is it's a test match. It's not a one day or a 2020. So that was my first, I guess, innings. The second job I had was at a company called ICAP Next, around $2 billion of revenue. Working with the board closely and the founder and the management team there, really, in-house driving corporate strategy, worked on a lot of deals. That was a business that grew because of acquisition. Had a lot of organic growth, but a lot of the businesses were acquired, and the nature in terms of how we integrated them or didn't integrate them, I think is fascinating. And how do you keep founder CEOs on the management team? Do you go hard in terms of integrating everything, or do you give people autonomy? So I learned a lot there from the board in terms of that. And then, we did a lot of transactions where we were largely selling businesses. We bought some small bolt-on acquisitions, and I've got some insights from those. But, most of the M&A we did was selling the business. And again, M&A is, it's a super tanker. You can't just wake up one day and go, you got to sell the business because business is declining or so forth. You have to plan several years ahead. And that's why I go back to the, the analogy of the kitchen and making sure that you're cooking properly. You really have to think several years ahead because, M&A takes several years of negotiation. And often when you see a deal, it's like, oh, that's obvious. But actually, some of those transactions, we negotiated them over many, many years particularly where there aren't multiple buyers. When you've got multiple financial buyers and it's a really, really hot segment, that's kind of different, and M&A can move very quickly. But when you've got a niche you're in and you're your buyer is a natural strategic and there aren't that many of them, those negotiations can take years sometimes. And it's, someone on our board once said to me at my previous employer, deals get done between people, and making sure that those the planets align in the correct way, I think, is really important. So that was my second experience. Led some industry consortium, working for some industry bodies after that, and now I'm in scale-up land. I work at a company called Galytix. We are 130 employees, 4 or 5 different locations globally, selling enterprise software SaaS to systemically important banks and insurance companies. Very, very different, but again, you learn a lot about founders and sales cycles and so forth. And technology has a people aspect to it. I think everyone is in this SaaS world where we always assume that you just integrate platforms and so forth, but the sales, the business development, the creativity, actually, M&A integration. There are lessons from other industries, and we were talking about advertising, I remember yesterday, and there are lessons from those industries as well for SaaS businesses. It's not just SaaS has technology and doesn't have a face to it, so M&A integration is completely different. So that's really my background.
So that's fascinating. So I think being on the sales side and being a guy that's got marketing, you've got I would say a broad base, exit valuations. I mean, we one of the key things that sort of stood out for me was the integration of electronic assets into the largest group. I want to just touch on that. I mean, give us a definition of electronic assets, as opposed to digital or other assets, if there's a difference.
So in that example, we're not really differentiating. Obviously, when you think about digital assets, you think about blockchain, you think about crypto, whereas electronic is sort of web 1.0, web 2.0, depending on your definition. But the reason is that the company I worked with, ICAP, for 7 years, we had a voice broking business, a traditional brokerage, which actually used a lot of technology. There's a lot of technology platforms used by our brokers and so forth. There was some pure electronic platforms as well, and there was a large technology budget there, but it was essentially thousands of brokers picking up the phone and shouting prices down the phone to banks and asset managers and making markets. And that was the business I grew up in the late 90s. But in ICAP, we still had a large business in that space. But the most valuable business, at least in terms of shareholder value, in terms of when we sold the business, was actually our electronic assets. They were exchange-like assets where you didn't have a broker, and we ran electronic trading platforms, so like an exchange group, but it was an over-the-counter platform. So we used to trade trillions of dollars of bonds and foreign exchange on our technology platforms. And banks and asset managers were our clients, and it could be a person on the other end who's tapping a price into that platform, or it could be an algorithm and a quant-based. And obviously, there was a trend towards quant-based and algorithmic trading. And then we had a variety of other sort of what we call post-trade and optimization tools and businesses which use technology. But I guess why I differentiate between the two is those electronic and post-trade assets were, you had people that were in sales and new business development and in finance and all those functions, but you didn't have, and the client-facing person was the sales guy who was selling the technology platform, selling the optimization or the post-trade tool like a SaaS product. It's similar to what we're doing at the moment, but slightly different ticket sizes and slightly different industry verticals. And I was really differentiating between that and the brokerage business, which was a more of a people business.
Yeah, it's fascinating, and for me, and you mentioned about the people side, but I think what often happens with systems, we talk about SaaS as if it's a silver bullet, or technology as if it's a silver bullet. But if you think back to the early days, and even now, no matter what piece of software you buy, you try to implement and so on, there's still a large amount of intellectual property that has to be incorporated into that asset, if you like, or the software to make it work, to make it valuable to the company.
Completely.
I mean, a piece of software is not valuable unless you've built your systems and processes and procedures and user access permissions and even your products, your customer list. I mean, I'm going to go on, but I mean, just give us a flavor of that.
Yeah, I mean, people naturally think about people businesses, and I used to cover asset managers, for example, and followed that sector for 20 years. And asset management is one of those sectors that has had a lot of M&A. It makes natural sense for consolidation, economies of scale. You integrate your back office, your IT, your Salesforce, and you get natural economies of scale. And then there's also industry pressure from the point of view of passive investing and so forth. But then you've seen a graveyard of bad asset management transactions where someone's bought an asset manager and actually the star fund manager has walked across the road. A very good friend of mine who's a hedge fund manager used to always say, well, the assets have legs and can walk out the door. These, in terms of how you value them. The natural thing as we think about technology businesses, I think, well, the assets can't walk out the door. There's no star hedge fund manager there or star producer that can walk out the door. And the brand does stay and the IP does stay, but there's a lot of things that are people intensive in a technology business that are really relevant. And it really depends on what you're trying to achieve. Are you trying to just integrate two platforms and it's a mature business, or are you trying to really drive growth and innovation and new product development and so forth? Because if you're trying to do the former, then it may be fine. The people aspect doesn't matter as much. But if you're trying to do the latter, which is drive innovation, and you're buying this business for the product development and the product life, the life cycle, then I think people matters. And I think it matters in two areas. I think there's firstly, people always assume technology is a black box, as you said. And as we move from algos to AI, it's almost like, Terminator and Arnie and, Skynet, as they say, you assume that, the AI takes care of everything. And it's not as simple as, you've got the input and the output and the AI that sits in between. And I saw something on social media the other day. So, and I won't credit myself for it, but it sort of went through the orchestration layer of AI, and we see that internally. Most of our headcount at Galytix, the 130 employees, aren't actually AI guys and technologists; they're data engineers. The data engineering layer in in tech businesses, SaaS businesses, is so important. It's the labeling, it's the versioning, it's the metadata, it's the lineage, it's all those things, data governance around it, and then there's obviously the data science model on top. And there's multiple functions. People always assume the AI is one black box, but there's multiple functions. And understanding who does what, going back to your M&A lens, and who do you need to keep post-acquisition, and who do you not need to keep, and what businesses scale naturally, and what businesses, the acquired business has talent in data engineering or data lineage and data governance, so you want that, and that accelerates your growth. So there's we call that at Galytix the data factory. That's a proprietary term we have. In terms of, people always talk about, picking up and dropping software, and we're a SaaS business, but what we have is we also help you to fine tune your algos. We help you with your data engineering. And we find that that's the biggest pain point that our big banks and insurance clients have is actually, you can pick up and drop some software, but actually, it's the spaghetti of the in-house systems. And, how do you fine tune that algo? You're one bank versus another bank, and your data is different. Your data engineering capabilities are different. Your silos are different. And, understanding what you can pick up and drop and what you want to pick up and drop, and then what on top you want, which is what we call the data factory. So the end-to-end data lifecycle. And I think that's really, really important in software businesses. And the other thing is, in particular earlier stage companies, and, we're 8 years in, but, we sell very, very sophisticated enterprise software to sophisticated banks and insurance clients. And it's really the founders, whether it's your CEO, who's your chief commercial officer as well, and is your chief head of sales. And we always say internally, we have this discussion about, well, who's going on that sales pitch? And our CEO is our best sales guy because he's built the product. And it's not just a startup world. I think in the scale up land, you need, at what point, do you still need the founders? And that could be from a sales engagement, or it could be from a product roadmap, or from the secret sauce and the algos and the data engineering. And the reason I highlight data engineering is there's so much open source software out there. AWS and all these big guys provide all sorts of algos out there. Everyone focuses on the AI layer, but it could be the data engineering layer. And actually, our two founders at Galytix, one is the CEO and the chief product architect, and the other one is actually the chief data engineer. Which naturally you think about it's the AI architect, but actually we use some proprietary algos, but it's also some open source stuff there. And that was also the history of the company I worked at previously, which was very different in scale. $2 billion of revenue, 45 locations. We had more legal entities than hot dinners. Very FTSE 100 business for a long period of time. But we had a founder CEO who'd built it from, essentially a shed. It was one, a desk and a couple of guys on the desk in the mid 80s, and sort of grown that over time and grown it very successfully organically in that broking business. And then acquired where we needed to drive scale. And you sort of integrated the back office and you added voice brokers and added brokers on top and producers. And then we pivoted into technology businesses. And we sort of understood the culture of the federation. Do you integrate, and it varies by acquisition. Do you integrate really hard and everything is rebranded, everything is, it's cost synergy and so forth, or do you keep a federation of companies? And I think it was the history of the voice broker where you buy an asset and the asset, a lot of the intellectual property, there's no patents, there's no IP. It's the brokers, the brokers' relationships with asset managers, hedge funds, traders at banks, and so forth, the producers. And that could be in financial markets or it could be energy. So you're very cognizant of keeping those, because otherwise, what were you buying? So you would integrate the back office, the IT functions, the finance, and so forth. But you would often give them autonomy. You'd have a slightly separate brand. You'd have a slightly different reporting structure. And that was also important when you engage with clients, because sometimes the client didn't want to give you too much business. They wanted to have multiple brands. And that DNA really taught us from of keeping this federation on the voice broking. When we acquired electronic and post-trade assets, where we had an earlier stage company, where we had founders that you wanted to keep engaged. The worst thing is, you buy something and the IP is the founders or the management team and the brand, and then you just rebrand it. And you completely integrate it. And the founders, well, they've got that cash. They've negotiated a great upfront without an earn-out, which is, cardinal sin number one. And I think it goes back to that sort of, and I always say that the federation versus the tight, complete integration. And there's no playbook. It depends on just the deal, really, to be honest.
And also the dynamic of the people, because I mean, people talk about culture, but I think it's not deep enough, because there's also dynamic. There's interactions, there's relationships, there's connections that have been created over time. I mean, we all know over years of working within an organization and externally, you build up networks, you build up connections, you build up the go-to guy when something goes wrong. That kind of stuff, you can't really buy that. I mean, it doesn't sit on an income statement or on a balance sheet or whatever. Very difficult to value that as well. When I look at that, I mean, when I listen to you as well, I mean, there's a big emphasis on sort of data management and so on. But when you're looking at sort of integrations and even these days, and with banks and so on, with all the new regulations and things and the changes, they're often these days being forced separations, carve-outs. There's a whole host of changes, not just integrations. I mean, I know on the sell side, when you're getting ready for sale, you're obviously trying to get the highest price. When you're on the buy side, you're trying to pay the lowest price. And that's the dynamic that happens pre-deal. And then post-deal, everyone then is trying to find a way to work together to get joint highest value possible together, theoretically. Tell us a bit about your view of the world on that sort of theory versus the practical side.
Yeah, and I think people spend so much time worrying about a basis point here or there, or 100 basis points, on a transaction. I think I think you hit the nail on the head in terms of actually, what do you need from the asset that you're acquiring? If this is a pure platform business you're buying, this is a mature business, you can sell it through your distribution network. Your brand is stronger than the asset you're acquiring, and it's pure IP. You don't really need to worry about that. But if you do need the founders, or you need part of the senior management team, or you need the brand, creating that incentive structure around it, and that governance, and it could be board seats. How many board seats do you give to the other side? And I always say that actually, more than the terms, if you're acquiring an asset from a very, very savvy seller, then you want them in the tent. You want them in the tent. You want them in the tent. You want them on the board. You want them, to have some incentive to be around. And that's across multiple scales. And I think that can be tens of millions of dollars of revenue business, or it can be hundreds of millions of dollars, or even billions of dollars. And how long do you need them? and in what capacity do you need them?
Hmm.
And I think the incentive structure around that is really, really important, because if you're letting them cash out, or in these public transaction, you could say, oh, it was an all stock deal. But if it's a large company, and I've looked at M&A for 20 years on the equity research side and looked at these deals, it's kind of like, if it's a large transaction, it's liquid stock, then it doesn't really make a difference if it's cash or stock, as long as the stock doesn't tank before the deal closes. The seller can get out, basically. So it's really it's really about understanding incentives, motives, culture, and that was what I learned, I think, going from being external to internal. So I spent most of my career in external, looking at M&A from the outside. You're an equity research analyst, you're on the buy side, you're looking at deals, and the stock pops, it's a good deal, it's a bad deal, and you're looking at the disclosure from the company around cost synergies are this, and the bigger the cost synergy, the better. On the announcement day, what's the revenue synergy? Could it, are they talking their book? Is it conservative? Is it not? You do some channel checks around it. But I think and a CEO I once worked for used to always say this. Well, people always forget the culture thing. You guys don't ever ask the culture thing around whether, and that's around M&A, or it's around strategy generally. I think and it's a real contrast in public companies and private companies. Private companies and the VC world, and obviously, we're an early stage company. It's all about the founders, particularly in tech. Whereas in public companies, people focus on those financial metrics. And how often do you get culture in those decks? And particularly, what's the go-to-market?
I'm yet to see a culture line item. I don't know if you've ever seen
intangibly, and it could be people, but it could also be brand. Brand equity. Are the two brands stronger together? Are they? Do you want to just replace that brand, or what's the go-to-market strategy?
Well, what I also picked up is that's certain in its culture, but it's also what's built into the DNA. Sometimes organizations are let's take tech-based entities, often started by a good tech guy that happens to also be good at sales, right? So he managed to have a friend that was good at tech, and he was good at sales, or she. But starting that sort of the dream business. I mean, we could probably go through a few examples of those.
Yeah.
But I think then as the organization sort of grows and progresses, then whoever wins the battle, because I think if then becomes a heavily sales or marketing or sales driven organization, it's all about product and volume and numbers. Or it could be alternatively very much around the technology. It must be solid, good, it must be whatever, because often the sales guys go out and sell stuff and then hope the developers go and develop it. Or the developers say,
you're all selling ahead.
Get this thing perfect. And then so there's a cultural thing, there's a dynamic between the different teams. If you look at educational organizations, you have the curriculum developers versus the commercial side of an educational type business or training business. In your world, if I look at your financial markets standards board that you were in, the market structure and technology, I just, if I may, just sort of pull out something there which I thought was very, very very interesting. So you looked extensively at the impact of machine learning, the AI, on financial market structure with industry participants, regulators, and the Alan Turing Institute. Now, when you're looking at that sort of market AI tech, I mean, there's so many different things at play, and there's also constantly a shifting market as well. I mean, there's nothing ever static. So today you're making assumptions because you make hypotheses. I'm guessing you think this is the way it should be, and you try and test that. But then in 3 months, there's been some kind of event. I mean, in London, we're experiencing incredibly high weather conditions. I mean, it's going to change the mood. It's, the high temperatures and so on. There's fires all over Europe. But 3 months ago, everybody was talking about Ukraine. And then the previous few months, we were talking about a pandemic. And I mean, it's just crazy. And this whole dynamic shifts all the time, yet you've got to try and create a working model. Tell me a bit about that sort of what goes on inside a guy like you. I mean, when you start playing around with these things in your
Well, it's always having a plan B, and I'm always surprised. You negotiate as hard as you can. And that's the thing with, I think, with M&A, pre-doing an M&A. You negotiate as hard as you can. No one wants to look like the desperate guy or lady, looking to sell. Yeah, and you want to do it from a position of strength. And there's a balance between between that and post integration as well. Having a plan B. What could you do with that asset? If plan A doesn't work, technology changes, something, changes inside the business. And it's being ready for the sort of unknown unknowns or the known unknowns. And I think I wrote something about this for the FT recently, and it sort of talked about the story of Abraham Wald. Abraham Wald was this Hungarian maths professor who worked in World War II around planes, and all the planes used to come back from World War II, and they would all. And all these maths professors and algo, and today it would be algos, would look at all the, where are the bullet holes on those planes? And that's where they would focus on their attention. And actually what Abraham Wald said is actually look at where the bullet holes aren't, because those are the planes that are not coming back from World War II. Look at, and I think Donald Rumsfeld famously described, I think, during the Iraq War as sort of the sort of known unknowns and the unknown unknowns, I think, from memory. I think, because M&A takes typically quite a long time. If I think about deals I've been involved in, you negotiate for many years. So actually from the beginning of when you're looking at it to when you announce the acquisition, it could be multiple years if it's a public deal. People don't see that. It's like the iceberg. People don't see that apart from the M&A bankers and the lawyers behind the scenes. The public market doesn't see that. But it could be years of negotiation and, toing and froing between CEOs and so forth. And then once you announce, you're typically going to have antitrust if it's a large deal. And that could take you a year, could take you longer. And if it's a people business, there's the integration, it takes time to bed things down, rebrand, go to market and stuff like that. So what's your plan B if one of the founders leaves, or you decide you want to shoot one of the founders? Yes. Typically you'd want to give them an earn out. And, I used to discuss in the old days, people used to always say like, oh, well, that's too much money. And I always thought actually earn-outs should be as generous as possible and the upfront as little as possible. And actually, you want to minimize your downside and actually share as much of the upside. And you want to structure it in a way that it's not like binary. I think people always look at things binary where, and obviously if you're a founder, no one wants a long dated options trade to use my financials sort of background in terms of no one wants an earn out 10 years from now on you going from 20 million of revenue to 2 billion. And if you don't get there, you don't get paid out. You want baby steps along the journey. So you want to minimize the upfront, but you want to have an earn out structure where it's baby steps along the journey, where it's not all one big, financial, 5-year clip fest.
Because it's a hockey stick, isn't it? It's like we've flatlined, or we had some trouble over the last few years, but all of a sudden, from next year, everything's just going to go up.
And always, there's always been a discount, and you never take a founder or a CEO's projections and say, well, your earn out is based on all of that. You make it reasonable, and you think, well, how much are you in the money? You paid $100 million for this asset. You want to minimize as much of the upfront as possible. And then in the earn out, you actually want to juice it, and you want to have as much earn out early in the early years. How long do you need the founders and the senior management team, and who do you need on the senior management team? And what do you need for them from? So you want to have as much juice in the earn out in the early years, I think, because I've seen these structures where you have the upfront, and I've had these negotiations. Oh, well, they don't want the earn out. Yeah, because it's like somewhere out on the curve, and it's like, and we've all worked at banks where your share options are worthless, because 10 years later, and it's not your fault, it's someone else's fault. Because
you lose control. It's not
you
no longer in control.
And founders love control, as you know. I'm still amazed by how the structure between the upfront and the earnout, particularly the curve and the J curve of sort of, you want to minimize your upfront because let's say this thing, because you always see revenue growth into a sale, because the founders, they're insiders, just like, and it could be a founder or it could be a public company. Do you want to be on the other side of, of those people? So you want to minimize your upfront, but you obviously, there's always going to be an upfront, but on the earn out, what can you give them in year 1 or year 2? And it's easy hanging fruit. You hang around, you do the chairman thing, you do the statesman thing, you help us with the brand, you help us get revenues from here to there, or clients from here to there, and then you get this much. And at that point also, you've not given all that cash out, so you get you look under the hood, you check the IP and the data engineering and so forth, and then you get that, and then you get stages, and then you can have you can renegotiate on the way or later on in the
Yeah, I was just going to ask, you may have seen some of these things before, but pre-deal, and as you said, it does take time to build up a decent deal. Then there's the announcement of what it is that we're trying to achieve. And this is just a perception. I mean, you must tell me if it's validated or not. But I very seldom get the announcement that there's been the integration has been successful. So there's no big event that says, hey everybody, we've achieved what we announced we're going to do in 18 months ago or whatever it was. Have you ever been at one of those events?
In public companies or private companies?
Well, just anywhere. I mean, in public and private.
My background is much more in public companies until 12 months ago, so forth. Obviously, I've been involved in investing in private companies and so forth. And in public companies, no one ever says an integration goes wrong. I've never seen a finance director, a CEO, or a board say, well, we missed on integration targets. And a CFO I once spoke to about this on a deal, and said, well, we hit the cost synergies targets. What are you talking about? And I'm like, well, sure, there's always a way to fudge the numbers. And finance directors, they may be former accountants usually, albeit in the US they're not. That's one thing they're very creative at. Where do the costs? And to be honest, if you have a hard integration as opposed to a federation of companies, yes, you get some external agency to audit those cost synergies and so forth. But it's how do you've had a hard integration, and people have changed in those 2-3 years because it's a 3-year cost synergy target, and typically year 1 you spend, and there's a J curve on the cost synergy line. And the cost synergy, you can get an external agency, to audit that, or to provide external validation to your board of that. But on the revenue synergies, I mean, boy, 3 years from now, how do you quantify, but particularly if it's a platform synergy and you're putting 2 platforms together, and one platform has distribution in one geography, and you can quantify how much revenue is going through that pipe. That's a pretty quantification. And I work with data engineers and data scientists every day, and 130 employees. I'm one of the few people who can't code, and I get this every day when I talk about sales and marketing and going on Dudley's podcast, perhaps, and they're like, oh, well, quantify it. And, most of the revenue synergy stuff is really hard to, it is, and if it's down the pipe, you can quantify it. You've got the pipe has distribution in the US, you are in Europe or APAC. The acquirer, then you can work it out. But what's cross sell? What's it's an art rather than a science.
But there's complexity as well, because that's assuming everything is linear. You have one acquisition, you got one integration, and the world stays the same, if you're making that assumption. But in essence, many entities, especially listed entities, are serial acquirers. So what they've done is in the meantime,
exactly. How do you do that onion apart? It's a spaghetti of onions.
Yeah.
It's not too. In business school, it's like 2 deals. You do the shareholder analysis, and then 3 years later, you check.
Yes.
When you get the bean counters to do the analysis, blah blah blah. But actually, usually, as you said, most companies, and you were talking about the advertising agency, the other market. If you think about that, and that was my first job, was actually looking at holding companies for ad agencies, and you look at the big holding companies and the amount of deals they did across ad agencies and marketing, and how do you peel
And
that
there's
onion
always a
back?
shuffle. There's always a shuffle.
And there's a shuffle and so forth. And then the deal, the deal synergy, like most things in life, it doesn't exactly work out in that period. I mean, I think about, my previous employer, ICAP Next, and I worked there from 2012 to 2019. We did largely sales on the sell side rather than the buy side of transaction. Some of the most of the earnings power and most of what we were able to sell in transactions was businesses we bought, a decade before. But the J curve on those didn't kick in straight away. So did those acquisitions look great in year one? Some of them did. Some of them looked okay. Some of them looked, there was one I remember that we looked great in year one. It was a Swedish post-trade business, and it looked great. But then in the middle, it didn't look as good for a variety of nothing to do with the management team, but a variety of market structure, macro reasons. And then regulation came about, and it was like boom. Suddenly, it was a great franchise, great mode, great technology in the right place. And suddenly, 4 years down the track, boom, you got a J curve. And it's not like it wasn't a great asset in the middle, but it was just market structure and macro headwinds. And I'm amazed by, and I'm coming from the public markets, by how people forget that there's the sort of, between the management team, and I think, we talked about culture and management team and the importance of that, and where I am, it's very, very important, not just in the sales, but also in the technology side. But in larger businesses, often market, at least in the near term, macro and market structure will drive it. I used to analyze bank stocks, and there isn't a lot of M&A in banks, partly because of regulation, too big to fail, and so forth. But most of what will happen in year one or year two of a bank transaction is macro market structure, and it could be the management team of the bank you're acquiring was useless. They had lots of subprime loans. They just bought them in 2007, and they were useless, and you need to shoot them. But but often there's stuff hidden in the balance sheet that won't appear for 5 years. And in the near term, if interest rates go up, that's good for banks because banks make more money, or GDP goes up. But that doesn't mean the acquirer's management, the management team of either the acquirer or the acquired bank is doing a good job. So it's also knowing what metrics to look at, because the bank's earnings are going up because interest rates are going up, or GDP is going up, and the credit cycle hasn't turned. So whereas they get their earn out, and then a couple of years later, all the bad loans are stuck in a. It's the story of GE, which is for me a great, the poster child of M&A. I think I was reading a stat. I think that there's no company in history that spent more money on bankers and lawyers than GE. I think they spent, I can't remember the exact number of billions they spent. And some of those mistakes were made under Jack Welch. He was growing in a bull market. He grew GE-CAP. If you remember, GE was an industrials business, and then they diversified into financials and GE-CAP, which was basically leveraging balance sheet. And Imlet, inherited that, and he had to unwind GE-CAP. But GE-CAP looked like a rock star under Jack Welch because there was no regulation, and credit was becoming looser basically, and Imlet had to unwind it. Albeit Imlet, was 7 years into the job when the financial crisis happened, or many years in, so he probably should have unwound it, or we should have had a plan B. And there's many criticisms I have of him, but that's an example of a company that was very focused on, there was an acquisition beast, and it was very focused on and paid a lot of fees to the streets. As a result, people said good things about them. You'll be surprised, until something goes wrong. If you pay a lot of fees to the street, people say good things about you. And GE was a prime example. All these books written about GE, and corporate America was clapping it. It was the Google of its age. It was no one was talking about Steve Jobs. It was like Jack Welch and GE, and his management style, and all these things were, and it was very focused on financial targets out of acquisitions. When if you're buying a bank, what would I be interested in a digital transformation? If you think about, how many, how many clients are using your online app? What are the next generation revenues? What are the product innovations? I used to have this when I was in house. What are the KPIs you look at? You look at revenues, you look at market share, you look at profits, you look at cash flow, you look at all these metrics. But you also want to look at those other KPIs around, well, new product revenues, new customer segment revenues, new. And I think when you look at an M&A deal, your earnout shouldn't just be structured on financial metrics. It should be structured on those sort of metrics.
Yeah, and I just comes to mind the transformation when you talk about banks transforming. I watched a documentary the other day about Macy's. I think Macy's in America, in the US, where Macy's was, I would say, the flagship department store where you could go and get pretty much all the different things, and it's more like a shopping experience, etc. And then they had obviously the decline, and how they've now transformed that into a hybrid shopping experience where you can do it online and you can do it, you could walk around and it sort of tracks you, and there's a whole range of things that they've incorporated. So their value now is in terms of the Macy's has become a buying experience as opposed to a transactional business where you go and buy stuff. And even banks, to a certain extent, is also shifting with the markets. Is how do you read that? I mean, if you had bought Macy's 10 years ago, you would have thought great business. 5 years ago, maybe not so great. Maybe you wouldn't have bought it.
I think it's thinking out on the curve and forget what and that's what public markets are really bad at, because public market shareholders, particularly, what's happened, quarterly earnings,
very short term.
Earnings are your friend. It's all about earnings momentum for that quarter, that year. Earnings are growing, the multiple expands, and you can sell the structural story on the cyclical. I used to always say when I was an analyst, the cyclical is going up, you can call it structural, you can call it structural and so forth, and so forth. And some extent in the private markets, I see that as well, because everyone's obsessed about revenue growth by itself as a metric. The earlier stage companies, it's an obsession with revenue growth rather than earnings growth. Public, and you see it in the whole software space. But I think it's the quality of those earnings is really that revenue. Is it sticky? Is it recurring? What's the threat on that? And then thinking further out on the curve. And at big organizations, you have that. And coming from the equity research side, which is the advisor world is very fragmented. So in the advisor world, particularly at larger companies, you have equity research analysts that advise the buy side. You have PR agencies that advise corporates on PR strategy and marketing and CEOs and so forth and so forth. You have the management consultants that sit in the big strat houses that go in and advise on strategy. And then you have the M&A bankers on M&A. And increasingly, they're all blurring into one. And you've got to realize, and maybe you just need the M&A bankers for M&A, because, and good CEOs and good management teams should know what acquisitions they do and why they're buying it. So maybe, but actually it all blurs into one. And even within organizations, I'm always surprised by how particularly big organizations they will have a chief strategy officer like I was, and they'll have a head of M&A or head of corporate development. And both of them may report to the CFO, or one may report to the CEO and one may report to the CFO. And typically the head of strategy probably doesn't come from my background of equity research. They're probably a McKinsey partner or a BCG partner, to be candid, or a Wyman partner. And the head of M&A corporate development is an M&A MD from a bank or whatever. And that's fine if you know what you're using them for. But increasingly the M&A, the quality of M&A is going to be a function of, yes, your ability to negotiate and the terms and so forth. But it's thinking out on the curve, because it's a super tanker. Whether it's and it's the same for organic growth. And I realized that when I went from the public side to the private side, a bad research analyst takes a few hours to write a research report and say sell Microsoft, sell on Palantir, or sell on I don't know, Snowflake, or whatever that tech company is, and because of XYZ. A mediocre one will spend a few hours doing their model and looking at the comparables and listening to all a good one will go down the supply chain. They'll go to the customers, they'll go down the supply chain of, who are these guys? Because ignore what the management team says, because management teams within reason are going to tell you something that's positive. And they're going to, and particularly with regulation now, they're very careful about what they can say and what they can't. So you go down the supply chain, you do the analysis, and it probably takes you a couple of weeks to go down the supply chain, speak to the customers, speak to the competitors, particularly the private competitors that have nothing to lose. They'll tell you where the bodies are buried. Speak to the former management team. And so forth. But but when you think about changing your organic strategy, it doesn't happen overnight. It's a multi-year thing. It's a multi-year thinking, and it's the same with M&A. It's a multi-year process. You need to have an M&A playbook. This is the areas that are going to grow. This is the areas that are going to go weak. It's the white space system that all the consulting firms do. And then can we play? Because I've seen all this white space stuff, and I'm like, yeah, fine, but how do we play there? Oh yeah, you can play there if you pay 50 billion times earnings for this high growth business, and your PE is really low, and their valuation is really high, and your shareholders will probably buy you on the way. But so it's also, can you play there either organically or acquisitively? And can you dip your way in by a joint? Because those deals, as you said, those good M&A deals, often the CEO has known the other CEO or known the company. Because CEOs often change if it's not a founder, but they know the company or a board member, or they know the space for a long, long period of time, even if it's a tangential space. The good CEOs are always thinking, what's out there, what's in a tangential space, and they're sitting in their, I don't know, CEO club, wherever it is, and they're thinking, oh, I met this other CEO, that business is interesting. Should I go into that industry? They have the same core economics as us because they're a tech platform or they digitize things, but they're in a different industry vertical. Can we go in there? When would we go in there? And you sort of learn slowly about that.
Yeah, I love that. I mean, you're fascinating to speak to, and Rupak, I think I want to. I mean, we're coming to closer to the end, and I want to just make sure we cover a few of the items. The last few items that I want to cover before we get to the end of the hour. The current position that you hold. I mean, you've come from a massive, a large a company that had thousands of employees, etc. Now you're working in a smaller entity. I just want to get your personal experience around what's it like in terms of making that personal transformation, personal transition between that, where there's so many different locations, people, whatever, and then all of a sudden it's a smaller office. There's probably more to do. There's more things happening. You probably have to keep your eye on a few more things. I'm just making assumptions, but tell us a bit about those sort of that transformational journey going from that sort of large to small.
Yeah, and I think there are challenges in both. Big companies have challenges, complexity and sometimes politics and sometimes different factors. And actually, the big company I work with was actually quite entrepreneurial because we had a founder CEO who was the largest shareholder. And B, we had a lot of market structure and macro headwinds. So we were fighting fires a lot. It wasn't a bull market for that business. I think when it's a bull market for a larger business, I think it's slightly different. But I think it goes back to one word: hustling. I remember and I say this when I interview people. You could be at a big brand name firm now. Could you transition to a smaller firm? Yes, of course. You've got best practices from that big brand name firm if it's a good brand name firm. You've learned things there that will transfer. Your Rolodex will hopefully transfer as well. But it goes back to hustling. You have to hustle in a different way, i.e., when you're at this big brand name firms, doors are open. And I almost go back to my first job of an equity research analyst. Your biggest asset managers return your phone calls straight away. If you are in a big brand name, one of the top investment banks at what they do at that time, and you've got a massive sales force. My first job, I was an equity research analyst. I was something called institutional investor. I was highly rated in what I did. I had a franchise. I would go on the road. You jump on the trading floor at 7 a.m. You shout some views into a morning meeting, and you had 150 people selling that across the world, across all locations. You had a trading desk that got behind you and put that balance. So it was, whereas we're a smaller business, particularly where and we've taken the view to build a product and build the technology first. And I think that's one of the reasons I joined Galytix, is build a product and build it, because I see it all the time. Smaller companies, it's very, very cool to just become a social media frenzy and become a media and marketing frenzy. It's really and particularly in enterprise software. I think enterprise software is a long sales cycle business. It is a C-suite decision making. It's a marriage. This is not about going on a date. That client, it's a large deal, and it's going to be in their risk engine. It's going to be systemic, or it's going to be influential to that organization. So they need to get to know you over time. And I call our clients strategic partners. I don't call them clients, because
Yeah, good.
it is a major. So focusing on the product and the technology, I think, is really, really important. And then wait and be very careful about how you market yourself and brand yourself. We're very focused on coming across as thought leaders, and sometimes we succeed, sometimes we fail, but and thought leaders on the tech side, but also thought leaders on the idea side, because I think bits and bytes, everyone is doing that thought leadership. The West Coast owns that bits and bytes stuff, and they're spending billions, and every VC backed enterprise software does that on the bits and bytes, and our AI is this and our AI does that. But it comes back to business user. At the end of the AI and algos and tech is going to be used by a business user. So what is the pain point suffered by them? And I know that sounds very corny and generic, but you'll be shocked by how people still forget that, and they still start with the bits and bytes stuff. And then how do you engage with them? And I think it goes back to, and I think Steve Jobs was the best salesman in history, perhaps. And I always believe that marketing and sales in business really has to be owned, particularly out of smaller companies, but even you see it at large companies, from the Elons to the Jobs of the, there has to be some CEO and senior management ownership, whether it's a CEO or a strategic CEO like me, or a CEO. All the senior management team have to be out there, building the brand together.
Yeah, and you often see, and this is just digressing slightly, but you see companies morph sometimes, where you've got the owner founder, they're driven, they've got all the sales marketing ideas, they manage to build good networks, they get the product to market, they've got good partners within the business developing products, services, whatever. And then eventually they exit, and when you look again, there's somebody with an accounting, or the CFO has become the CEO, and has got very limited sort of, let's call it, flair around it's making
the natural
sales.
thing is to hire the ex accounting, and I think at a really large company, if the CFO's job is pure financial reporting, and there's somewhere in the J curve, where it can be that, but I think the CFO has to think of themselves as a thought leader as well. They have to think themselves as a strategic CFO that looks at doesn't just look at reporting going back, but looks at the forward, and looks at not just the forward, but really looks at scenario planning on the finances, plan A, plan B, plan C, return on capital by project. I had a very good divisional CFO. I'm thinking back at my ICAP days, he used to think about this, and he used to blow me away. And he's the CFO of a public company now, who's very, very good at that return on investment, and really stress testing the business and where the spend goes, and asking those questions. But also, I think everyone's got to be out there in terms of and return on capital investment. I think there's marketing, and then there's. I think the difference between, people tend to think about technology as an island and sales as an island. And I actually think that, yes, you can't be a technologist if you can't code, or, you can't be a data engineer if you don't have these skills, and you can't be I think that then there is an overlap.
Very much together in one. They've sort of the DNA has joined in a way, if you think about it. I want to just quickly, Galytix, if you look at the early warning system product, if you want to just share a little bit about that, about the company, just tell us a bit more about where you are right now, and what the company does, and who would you like to talk to if you were out there needing to speak to people.
So we provide a sort of iOS, Windows type data operating system for data for banks and insurance companies. It's a connected data ecosystem. The differentiation is it's an end-to-end data pipeline. Some of the companies in our space, the Palantirs of the world, will provide the analytics and some of the layers, but we provide an end-to-end data ecosystem, all the way from data discovery. And many people already discover a lot of this data, but it's manual and it's time intensive. But with the internet and social media, there's so much data out there. But we, at scale, our algos and our web crawlers will go out and discover data. One of our clients, insurance client we were talking to the other day, hundreds of data sources, thousands of time series, and we do it continuously. It's not in a batch process. So we follow all the way from data discovery to data ingestion, and it's all algorithmically done. Structured data, unstructured, all the way into data transformation and data cleaning, and and all the data governance things around tagging, lineage, and so forth, to analytics. And where the early warning signal product comes into is really analytics layer. And I remember speaking to a friend of mine who runs a markets business in one of the banks last year when I joined, and I was talking about this vision I had. And we published a report on it. I don't have it with me. I would always wave it otherwise. But we produced a report on this with our strategic partners, PwC. We worked with dozens of banks and chief risk officers of banks on this. And this friend of mine said, yeah, it's all good, but no one ever defaults. No one ever, everyone always pays back loans unless they're real crooks. And that was last year, obviously, because we had this 40-year credit cycle. But if I look at our banks and insurance clients, our product is more in demand than ever because risk is rising. We're finally seeing a credit cycle. Banks really care about credit risk. Insurers care about risk. You've got underwriting risk from climate change to all the things you see with inflation and all the other macro and micro trends out there. But the end-to-end data platform is a key differentiation of ours. It's fully automated, but we do provide some human supervision of it. A lot of SaaS businesses will just pick up and drop technology, and that's all good. And we're happy to do that if a client says just pick up and drop your technology. But what we find is our clients want us to work with them. They want us to engineer the data with them because they'll want certain data sources that other banks don't want. And they don't want the data mutualized because you see it with big tech. No one wants that. And they'll want the algos fine-tuned. And I've written about it in some of the op-eds I've written. Past performance is no indicator of future performance. Causation versus correlation. If you just rely on 100% algos and there's no human intervention to the fine-tuning of the algos, the data engineering layer. So and we have a scalable ontology framework, that can be leveraged on top of that. So we're 8 years old. The founders are very, very focused on building it, and the first 5 years of the journey was very much focused on working with certain insurance companies on a project-by-project basis. But it's really exploded in the last 2 years. We were, I think, 10 employees 2 years ago, and we're 130 now, 4 different locations. But again, it's really about strategic relationships. It's not about clients. And I was interviewing someone for a senior role the other day, and they would say, "How many clients have you got?" And I was like, "Do you not care how big that client is?" Because we call it it's the expand and scale, land, expand, scale model. And that relationship is valuable on both sides because the land is important, but it's how you expand and scale within that that large client. Add use case, add technology.
I love what you said earlier. It's a strategic partnership with your client. It's and I think it's so much more prevalent in today's world. Is no entity, no company can be a master of all elements required to have a successful business. And strategic partnering with various really strong entities that add an extra value, an extra element that just doesn't exist. You cannot just go and employ someone and say, come and do some data work for us. Doesn't work like that. You need a specialist organization that's thought about it.
Large enterprise software, clients. And the bits and bytes are important. The algos are important, but it's kind of like how are you going to help us execute? And also being a trusted partner for them, a thought leader for them, where you're not just like on the phone, can I sell you something? Can I show you a demo? It's like, and that was what the early warning system paper was about. We went out and spoke to 10, 15 of our largest relationships, many of them clients, big banks, and work with our strategic partners, PwC. We have a global relationship there to get some thought leadership out. And marketing it, a friend of mine said to me, well, you're telling all your ideas to the market by publishing all this. And I was like, I'm happy for it to be out there. Happy to share that information. We're not sharing any proprietary code. Happy for that information. And if that's all we've got to sell and that's all the ideas we've got, because actually it's not, those are ideas, but how do you implement them? And how do you take that autonomous car and how do you drive it in a road with bumpy roads and where there are no signs? Because that's the key.
And it's so, anybody can have an idea. Anybody. It's making it work. And going through that learning process and testing and trialing and improving your intrinsic knowledge and the whole thing is to have a value proposition that's relevant to your particular target market. And if your target market is a small universe but is quite large in terms of each entity, but has got complex needs across multiple departments and multiple areas
Yeah.
within that business, all of a sudden it's a completely different scenario to
Yeah.
selling a $5 a month or a £5 a month a SaaS product for bookkeeping,
That's why I think
online.
people distinguish between B2C and B2C, but sorry, B2C and B2B. And I haven't spent 25 years of my life in this space. I come from financial services, but sort of having gone into that tech space the last decade, there's this neat distinction, and I just don't think it necessarily works. As you said, if you're selling like a subscription SaaS B2B, like 500 quid a month, the buyer is going to be completely different. The strategic relationship is completely different. You don't need thought leadership on that. You don't need, and the addressable market in both is huge, because yes, the number of clients may be, the addressable market may be hundreds or 500 to 600 in our space, and in selling widgets it may be tens of thousands of of clients and so forth. But the ticket sizes are bigger in this area potentially. So they sort of balance themselves out. And I'm just intrigued by how we still we still like data labeling. It's B2C or B2B. When actually one end of B2B is actually B2C, and the other end is completely different.
Well, I'm just thinking about the back end of all those little B2C products, because if you think about it, a bank looks after a consumer or a customer. It could be a private individual, it could be a company, it could be a large company, it could be a small little business, it could be a retired individual with a mortgage. It could be anybody. I mean, if you think about financial institutions and so on, they deal with multiple people. So there's multiple people they deal with. So they're dealing with. So you indirectly still dealing with the end consumer. You got to enable a conduit, if you like. That's what a financial institution is, to enable the end consumer do what they want to do. I mean, I'm just saying. So it really is a joint, and you can probably look at it in different ways, philosophical ways, I suppose. But in a lot of ways, everybody is being affected regardless.
Yeah, and things like brand equity. There's a lot of things you can learn from B2C and B2B. People are B2B. We don't need to do sales and marketing, but you just need to do it. But there are things in B2C. You don't go on Twitter and rant all day, or Instagram, or all day. But it's there are lessons, and it's this, and I say that, and that's also representative in shareholders. We're very careful about the shareholders. It's not about quality. It's about quality of capital rather than quantity of capital. And the shareholders that understand our journey, understand the pain points, and can give us that candid feedback, and have that thought leadership where they can advise us and counsel us in the right way. And some of that's good cop and some of that's bad cop. And you expect your shareholders when you're not performing to be bad cop, but also the good cop side is really important as well. So our founders have been very careful about, because at the moment we're in this stage where everyone is obsessed with fundraising and putting out a press release. And I see it with some of the media content. How big was the raise? And everyone wants to be unicorn, 100 million raise on their website and say they're a unicorn. And most of these are fake valuations. I would say majority of them are fake valuations, because they're many of these investors have all sorts of anti-dilution rights. They have all sorts of protections. They have all sorts of things. But there's an element of founder, ego. We got to get the best print in the market, and because that founder he's a unicorn, I got to have a unicorn.
Yeah, it's all it's perception versus reality, and I just as a passing thought, I had that the bragging rights of someone who's just exited or sold their business or whatever it is, going to the golf club or the tennis club or going to the cricket grounds, whatever, having a chat to their mates and say, hey, I offloaded my business for 100 million. But what they're not talking about is they only got sort of $1 million in cash, and the other 99 is an earnout, and it's only a potential. They probably realistically walk away with 20, not the full 100, but the deal,
it's bragging rights, as you said, and it's the same.
It's bragging rights.
Exactly, it's the same with this crazy press cycle we've got and the unicorn, and now we're seeing all these down rounds, but they were never up rounds to start off with. They were fake valuations, half of these. They were, and actually there's a lot of smart money that'll be in every round. So you may have invested at the high round, but you were in at like zero valuation, and then you re-up and you up big on the down round because you believe in the business. But I think sort of getting through that noise, I think, is really, really important. And
I think with your background, I think you've learned to try and work through the noise. I mean, we're all still human, but I mean, we try and you build mechanisms and tools and things. And we've come to the end of the hour, Rupak. I mean, I'd love to have you on another episode if you're open to it. It's been fascinating speaking to you. But what I'd like to do, if it's okay with you, just ask: do you have any sort of final thoughts? I know we sort of cut it short because I think we can probably carry on for another hour or two. I just any final thoughts, any sort of takeaways? As something for the audience to think through.
Yeah, I think let me take it back to M&A, which is a lot of your other guests are interested in, and a lot of your other speakers have been involved in, and it really goes back to think long term. Don't just think about about the deal, just about the mechanics of the deal. Think about the culture, think about the equity story behind it, and think about what you're trying to achieve. Whether it's and I think those are the important things, and how you're going to incentivize that behavior. Because at the end of the day, it's people.
Yeah, absolutely. Brilliantly well said. And thank you very much for your time. Please stay on the line. I was going to say goodbye to our guests and to our audience, and then I'll be back with you now. So thank you very much, everyone, the audience and anyone who's joined. Thank you for the comments during the show. Thank you very much to the to join, and thank you very much to Rupak for sharing such wonderful insights. It's a completely different show today. It's done by somebody, I believe, that's got an incredible amount of experience and knowledge from a different point of view. And I think it's interesting when you start looking at and dissecting the way the world works. There are so many different dynamics to think through, and the changes in the market, and yet there are certain fundamentals that stay in place, things like data analytics, and also the things like customer relationships, strategic partnerships, making sure culture and culture fit are in place, and so on. When we look at mergers and acquisitions, especially the post-merger or post-acquisition integration work, all these factors need to be taken into account. The changes in the environment. And as Rupak was saying, many of these deals have taken time to put together. Things could have changed in the meantime. And as in integration, you want to think about the circumstances in which you are being thrown into in terms of an integration. Many times the ground still shifts underneath, and you still have to do the work on top with the integration work and with the, let's call it the initial strategic reason for that acquisition. Thank you very much, Rupak, for joining us today. Thank you for your time. We really, really do appreciate. To our audience, thank you very much for joining us. Please join us on our next episode of 100 Days and Beyond, where I believe we speak to those people that make things work in the economy, in the world around us, and really are the people behind the scenes that are what I call the unsung heroes of the business, of the business journey, of making those engines take over, those systems run, and even when it comes to IT and technology, those are the key things that are making businesses survive and allowing them to thrive in constantly changing environment. Thank you very much. Look forward to seeing you at the next episode, and all the best. Hi everybody, this is Dudley again, and if you need help with a future or existing post-merger integration, I want to invite you to arrange a free, no obligation meeting with us. During the meeting, we'll find out exactly what you need, what your challenges are, and we'll explain how our unique PMI slipstream method can help you. Simply call us or visit mergerintegration.co.uk. That's mergerintegration.co.uk, or come to our website, skillfulpursuit.com.